Good morning, everyone. Thank you for joining us today. It's 10 o'clock, so we're going to get started. My name is Ashley Brown. I'm the Senior Marketing Manager here at KLR, and on behalf of KLR Wealth, KLR, and our affiliate companies, I would like to welcome you today to today's webinar, 2021, a look ahead, where we'll give you a market update and some future tax planning guidance. Please join me in welcoming Peri and Aptaker and David Wray, our presenters. As you know, David keeps a close eye on the stock market and will be giving us an update on what to expect as we enter 2021, given the changing political landscape. And Peri, KLR Wealth's Managing Director, will be providing insight on some of the tax changes in the $900 billion stimulus package that was passed in December and some future tax planning tips for the year ahead. As always, we will be recording today's webinar and sending a link and a copy of the slides in our follow-up email. And without further ado, I'm going to hand it over to David.
Thank you, Ashley, and then also, Ashley, thank you for your hand on the tiller as we go through the few slides that I'll have to talk about. So I think everybody's looking at the agenda, market update. Why are we so bullish? Well, I am bullish. We are bullish. I think there is a great opportunity for wealth accumulation, wealth multiplication, perhaps, but certainly wealth accumulation over the next, even perhaps the next decade. It won't necessarily be a smooth, solid upride. In fact, I can absolutely guarantee that it won't be for the next over the next decade. But I am really, really positive about what's going on. Where we've come from has been brutal over the past year, and it still remains brutal. However, bull markets are created by people coming to the realization that things are getting better and better and better. That's what bull markets are made of. The news doesn't have to be good. In fact, when the news maxes out at the top, as we'll talk about the cycle in a second, that's really the time to be avoiding risk. But right now, it's time to embrace risk, in our opinion, and I'll go through that in a moment. Ashley, if we could flip to the first one, please. Okay, so everybody should be seeing a chart titled S&P 500 Historical Bull Markets over the last 100 years. And you can see in the lower left, this is to put the current bull market in just the context of prior bulls, measured on the x-axis, the percentage increase, and on the y-axis, the duration. And you'll notice, and I'll just say, first you'll see the red, where we are as of December 31st, we've probably gone up another 4 or 5% this month. So say 75% from the bottom on March 23rd. To the right, you will see sort of a clustering of other bull markets that are longer in duration, but approximately the same level in terms of magnitude. However, if you sort of pair some of these off, like that first one, 1987 to 1990, if you pair that off with a blue diamond above and to the right with 82 and 87, and you put those on top of each other, that 1980s bull market, to which I think this is potentially most directly comparable, would put you into that upper right area where the market quadruples over a long period of time. The same kind of quadruple we had in the 90s, the same kind of quadruple we had in the 2009 until the first quarter of 2020. So I think we are very early days in this bull market. There's a long way to go in terms of time and magnitude. Now, I will also say, as a caveat, I've been at this for 40 years. I could be wrong. However, my level of conviction now about this is as strong as my level of conviction was in the last decade. When we came out of that the great financial crisis, I was at another perch at another place at the time, a big shop, and I was the most bullish person on the strategy committee. And gradually, as the market wore on, others got more and more bullish. In any event, we ended up with a massive market move that paralleled the 80s and the 90s. So this is where we are right now. I think there's a long time to go. So if we could go a little bit further, one more, Ashley. All right, so those of you, and I know there are a number of you on the call who have been with me for many years from my prior perch, and so this will be a familiar chart certainly to them, and also perhaps a familiar chart to to those of you who I've only come into connection with during my KLR days over the past couple of years. I've brought this forward a couple of times. So this is notice the economic cycle. This isn't the stock market, but I will draw the connection. And before I talk about sort of what lies ahead, I do want to sort of review where we've come from and set the stage for my bullishness that goes into the rest of 2021 and beyond. So every economy, it's a cycle. Nobody's ever been able to repeal the economic cycle. Policymakers try to avoid any kind of right-hand side, but it's unavoidable because at some point the economic success, as we go from bottom to top on the left-hand side, creates excesses, and excesses, however they're developed, and every economic cycle has its own excesses. I think people can remember the dot-com crisis or the dot-com bubble of the late 90s, and then the real estate bubble that preceded the great financial crisis of 08-09. Those were excesses that the economy had accumulated over a period of time that frankly needed to be exorcised, if you will. The excesses that were created in this past, prior to COVID, and clearly COVID was the nightmarish catalyst for an economic decline. But we were going to get something. We had actually created too much supply and too many what I'll call indulgence areas. We really weren't building anything economically 17, 18, and 19 that were sustainable. We were creating a lot of indulgence. My metaphor is we were, too many Hampton Inns on too many exits between Boston and Miami and too many casinos. So we were creating a lot of jobs, yes, but they weren't. They were jobs holding towels and dealing blackjack. They weren't strong industry, manufacturing, or highly productive jobs. I'm sure the people who had them were proud to have them. However, from an overall macroeconomic standpoint, this was an economy that needed to be rebooted. And some catalyst was going to come along. We didn't know what. I was writing about this all through 19 and into the first couple of months of 20. And then along, as I said, of course, comes the nightmare of COVID. And so we have the economic peak first quarter of 2020. We shut the economy down, and you can see these sort of bullets. I know this print is small, but economic lockdown, the stock market had almost a 40% drop from February 12th to March 23rd. The 10-year Treasury dropped like a stone in terms of yield from high ones to 0.3. Unemployment rate maxed out at near 15%. That's the official rate. The actual, if you include those who lost their jobs, like Uber drivers from the gig economy, it was actually up closer to 20, and it's still in the double digits right now. And what that did, and here we're going down the right-hand side of the curve, it triggered a massive policy response, monetary policy from the Fed and the fiscal response, the fiscal multi-trillion-dollar CARES Act that was passed last spring or late last winter. And between those, that policy response, that created a trough. The lockdown happened. We troughed the economy in, say, May or June. We'll figure out the dating at some other point. It doesn't matter for the purpose of this. We hit a bottom, and gradually through the third quarter, we've been coming back up. Unemployment rate has already officially dropped to 6.7. As I said, unofficially, it's probably closer to 10 or 11, but it's improved. The stock market has been incredibly powerful. In fact, this response, this 75% rally from the March 23rd, is the all-time sharpest, deepest rally in terms of magnitude and for the duration that it had. Nothing's even close to that. Now, and we've just come through the fourth quarter, more things have happened, by the way. The economy started to reopen, and in fact, I don't think it's been shut back down. But of course, with the early economic reopening, we had a resurgence of the COVID. As we go through the fourth quarter, you see the vaccines, and the November 9th date of the vaccine was really the day that we got very bullish. We were already moving more positively in our portfolio allocations. On November 9th, that was a big day. The elections, of course, happened. And now here, as we sit here in early 2021, you see the reference to CARES Act 2, which Ashley has already sort of foreshadowed for Peri's part of the discussion. But we have abundant stimulus, and we now have the announcement of potentially another 1.9 trillion. I don't think when it finally comes through Congress, this is the 1.9 trillion that President Biden has been talking about. We'll get something. But that's only going to be a warm-up act for what I think the stimulus, the eventual stimulus will be. We will get a full economic reopening this year, and this economic reboot away from the indulgence and transactional will begin. Now, if we can flip one more forward, Ashley, then I'll further amplify on that. All right, so this is now a more broader sweep of the classic economic cycle. Now, just to sort of put this in context, I gave you sort of 1 year, a 1 year's worth on the last one. Generally, the economic cycle takes at least 4 years to play out. And if we were in the duration of the 80s and the duration of the 10s, it actually took longer than that because the magnitude and the duration of the economic recovery and reacceleration is absolutely proportional to the magnitude of the drop that preceded it. If we get my moving rating analogy that many of you are familiar with, having heard from me before, of G-rated, PG-rated, and R-rated slasher movie kind of declines as well as bear markets. When you get an extreme example of a deep recession, as we came through a double recession in 80 and then again in 82, and then the great financial crisis of 08, 09, and I believe this COVID lockdown recession will end up qualifying as well, could lead to something, an economic cycle that may transcend even the 2024-2025 peak that I sort of have established at in these early days of 2021 as sort of perhaps a small check down as we continue as the economic acceleration evolves. But let's sort of come back to 2021. And so now we've sort of reset 2021 to the lower side. And some of these things that have actually started to happen, abundant fiscal stimulus, yield curve steepens, the dollar weakens. That's actually a very important dynamic. It's not so much an indication that the U.S. economy is weakening in any way, shape, or form, but it's an indication that, and it's always been this way, and I can't imagine it'll be any different this time, that when the U.S. economy begins to rebuild itself, we take the rest of the world with it, and the rest of the world and the rest of the world has smaller economies and that therefore respond on a percentage basis on a greater magnitude, maybe not in an absolute sense, but in a relative sense. Currencies trade relative to each other. So when the dollar weakens, it's not so much the dollar is getting weaker, it's just the other currencies are getting stronger, to put it that way. That actually has important portfolio implications for how we invest. And we've already started redirecting some client wealth into international stocks, emerging market stocks. In any event, that's a specific granular portfolio. Back to the sort of the macro here. In 2021, we've had considerable volatility. We've had volatility since actually 2018. 2017 was a tremendous year for stocks as the markets were pricing in the promise of tax cuts. The tax cuts happened. We created a flash in the pan for the economy in 18, but they really didn't do the job that was expected by the policymakers at the time. They really weren't creating sustainable growth more than, say, 2% a year. So there was a lot of volatility of expectation, a lot of volatility of disappointment, and then, of course, the volatility that came through with COVID. I fully expect that the volatility around the mean for both growth and for stocks, by the way, should start to calm down as the year goes along. Employment is already starting to pick up. I think we're just early stage, and then earnings, corporate earnings, small business earnings will be picking up as well. 2022 will be the year that the economic acceleration will finally be widely recognized. The 2021 will be a year of a lot of skepticism. And I'll come back to my bull market comment before. Bull markets are, yes, good, better news is a catalyst. But it's the bull market itself doesn't happen unless money comes off the sidelines and into stocks, which it will as prior skepticism dissipates and becomes more and more optimistic. As I said, finally, when everybody's in at the point of highest optimism, then that's the top. No matter how good the news is, if you're in, you're in. There's nothing more that can be done on the upside. So we are still in 2021. I believe we are going to be still in a sort of a skeptical area of acceptance of the bull market. So far, it's been traders that have taken the excess cash that the policymakers have provided, both fiscally and monetarily, the Fed and plus the fiscal stimulus. And yes, a lot of that fiscal stimulus has gone to plug holes in the demand for, especially on the consumer level, because a lot of people, frankly, just had no access to capital whatsoever. But there's a lot of money that's been sitting on the sidelines the economy hasn't been using. This is the liquidity phase of a bull market. So if the economy doesn't want all this money, the markets are happy to take it. And so that usually happens, so quarter 2020 trough, that happens at, say, 5 o'clock on this. If we make this look like a clock, that, say, from yellow to green in the lower right is about when the bull market begins. And it begins with a liquidity phase of skepticism, fed purely by cash on the sidelines, certainly not by good news. But then at some point, there is good news. We're getting better news now. There were a couple of economic data points out this morning that were actually more positive than expected. But they're bounce around. They're slow in coming, they're slow in developing, and there's enough bad stuff in there, such as today's first-time unemployment claims being so high, to keep the skeptics skeptical. Meanwhile, the progress of the promise of the reacceleration is continuing, and I think it'll be 2022 when it's finally recognized. And you'll see the note, Fed normalizes. Right now, the Federal Reserve has interest rates held at, for all intents and purposes, 0%. At some point, that will begin to move on the higher side. It will be I think there's a question we'll get to later on about inflation, and you actually see that reference for the 2023. But that's a long way off. I say inflationary pressures begin. I'll more articulate later on. They really shouldn't become in any way injurious to the economy, or never mind to the financial markets, until perhaps 2024, 2025. But we'll come back to that. So I think we're in a bull market. I see my time is kind of coming to an end here, but I'll be back on later for questions. We're in a bull market. Still have the liquidity. Oh yes, thank you, Ashley. One more. So here's now. So here's the script. And this has sort of been a political context, and I know Ashley presaged that too. So this is the script going back to 1950. So not quite 100 years, but 70. There have been a number of times when the White House has changed parties. And I don't want anybody carried away with these downside. I mean, I've said we're in a bull market, but I've also said that there's volatility. And volatility, by the way, is sort of a euphemism or a code word on Wall Street for down. But I will look at the percentage numbers here. Again, this is an average, so there are plenty of years where have been in excess on both the upside and the downside. Most particularly, by the way, the downside in 2009, right on the cusp of a massive bull market. That move from down into the bottom on March 9th was far more extreme than what you're seeing here. So that's part of the average. When the White House flipped from the Republicans to the Democrats, from Bush to Obama. But you'll see that there's an uptick into January, followed by a little bit of a setback. And I don't want to overstate this. This is not a big deal. Followed by some rallies. So it takes a little while for things to set in. But you can see that to the right-hand side, final right-hand side. And this is a script and an average. It doesn't mean it will be followed. But it's something that I look at to make sure that our thinking is not kind of off the rails or beyond the white lines of prior expectation, as well as the ongoing data flow. So but from October on, things can get really good. Now, let me also mention two reasons why I'm so bullish. I mentioned fiscal stimulus, the stimulus package that Bush talked about. And Peri, I'm going to borrow a minute or two. I apologize, but allow me if you could.
That's okay.
Thank you. So the big opportunity here for the economic reacceleration is in infrastructure. We're now still plugging holes in COVID relief. The CARES Act from before, the big one, the CARES Act 2, even if that's not its official name, and then I think the Biden we'll call it CARES Act 3 for lack of a better term. These are all massively important to plug holes, current holes that COVID has created, and they will be vital, and that will be and that's part of the stimulus. But the real stimulus that lies ahead, the real stimulus that creates the economic reboot away from the transactional and the indulgence, will be an infrastructure bill. And an infrastructure bill that can be very, infrastructure, most people think of highways and bridges and ports and airports and mass transit, and they should. Those are a big deal. But climate mitigation is a massive, big opportunity for industries to be created. The Industrial Revolution that we all read about in elementary school history was obviously massive. I'm not saying we're going to get something on that order, but we might, because the mandate that must happen for climate mitigation, plus the fiscal stimulus that can put some power behind it, could be absolutely massive in creating industries, productive and well-paying jobs that can last a very long time and provide a multiplier. If you go to a hotel and check in and somebody folds the towels, yes, that's economic activity, but there's no multiplier behind that. When you create an industry with highly productive and important jobs to be done, there's multiple economic multipliers that follow that. Plus demographics. I'm a boomer. Peri, you're a boomer. Yes, we're retiring. However, we're not going away as economic importance. But my economic heroes are today's millennials, a bigger generation than ours by a lot, plus Gen Z to follow. Not only are we going to have a more productive economic reboot, it's going to be done with the power, the demographic power of the millennials and the Gen Zers who can just drive us maybe through this entire decade and maybe into the next one. All right, I'll stop there, and I look forward to coming back on when it's time for Q&A. Thank you.
You're a hard act to follow, David.
Not at all.
I don't know how I can say I'm so bullish about taxes, but good morning, everybody. Glad to have you with us. As you can see from the slide Ashley has on the screen, I'm going to give a brief overview of the recently passed legislation and our thoughts on what we think a Biden administration will do with respect to taxation. I will focus my comments on the tax law provisions affecting individuals that we think will be of interest to you. As you know, Congress passed and President Trump signed the Consolidated Appropriation Act of 2021 on December 27th. At 5,593 pages, this bill is supposedly the longest bill ever passed in Congress. I don't know how they do that stuff, come up with 6,000 pages. The act provides for an additional $600 refundable tax credit. This is different than the stimulus checks per eligible family member under a certain income threshold. So if you're a single individual, that threshold is $75,000 of adjusted gross income. And if you're married filing jointly, it's $150,000. For anyone who received a PPP loan, the act clarifies that the loan is not taxable income and any qualified business expenses paid with that loan are fully deductible. That was a big area that was not clear with the first act. The medical expense threshold for itemized deductions has been reduced from 10% of adjusted gross income to 7.5% of adjusted gross income. And as I tell my clients all the time, I really hope that you don't have enough medical expenses to qualify for this deduction, because that's not a good day. The energy credits related to energy efficient property and solar have been extended through 2022. There's also a new 2-year provision that allows business meals to be 100% deductible if the expense is for food and beverages provided by a restaurant. The current limitation up till now had been 50% was deductible. This is an attempt to help the restaurant industry because of the effects of COVID. I can only imagine what the catering and other hospitality providers think of this provision. There's also, for non-itemizers, a new charitable deduction of $300. In 2020, that's $300 regardless of your filing status. For 2021, if you're married filing jointly, you can take $600 as charitable deductions, assuming you paid them, if you do not itemize. And for individuals who do itemize their charitable contributions, there is no limit, or the limit on deductible charitable contributions has been increased to 100% of your adjusted gross income for 2021 and 2020. So people who are considering large charitable gifts, now would be a great time to do it. Buried in the 6,000 pages of the new law is a change to Section 7702 of the Internal Revenue Code. Section 7702 limited the amount of money an individual could stuff into an investment vehicle disguised as a life insurance policy. Life insurance remains one of the best tax shelters that can be found in the Internal Revenue Code. And as a general rule, cash in a life insurance policy grows tax deferred, and if managed properly, can be taken out of a policy. I know we've got a few life insurance people on this call today, and they're very excited about this. When Section 702 was enacted in 1984, Congress set a 4% fixed rate to determine the growth and the cash value for policies to be able to enjoy the preferential tax advantages found in the code. Because of the decline in interest rates over the last few years, it has become very hard for a policy to perform better than the guaranteed cash. So Congress recognized this dilemma, mostly because there's a very large insurance lobby, and that rate in the code has now been changed to a floating rate, and they've set it at 2% for 2021. What this means on a practical level is that whole life insurance, especially policies issued by mutual insurance companies, provide a unique opportunity for high net worth individuals to use life insurance as an alternative asset class. Separate from the big law that was passed at the end of the year, the IRS has changed the life expectancy tables for your required minimum distributions. And those have been changed to reflect the reality that people are living longer. So under the old tables, if you were 72 years old, you needed to take your required minimum distribution, take the balance of your account and divide it by 27.4 years, 25.6 years. Under the new tables, you get 27.4, so almost 2 years longer. And what that really means is you can, if you're only taking the required minimum distributions, you can take out less, and the balance stays in the retirement accounts and grows tax deferred for a longer period of time. And the new tables are effective for distributions starting in January of 2022. So not this year, but next year. So where do we think we're going to be subject to some tax increases going forward under the new Biden administration? Well, as David mentioned, President Biden has proposed a $1.9 trillion economic rescue package that includes bigger stimulus checks, more aid for the unemployed, the hungry, those facing eviction, as well as support for small business, state and local governments, and vaccine distribution. Whether it all gets passed or not, we don't know. We'll have to see what happens. But what it does not contain is any mention of how these programs are going to be paid for. Or to put another way, any tax law changes. And we believe that this is a purposeful omission, as President Biden wants to pass the legislation quickly and potentially with some bipartisan support. As President Biden tries to balance the interests of the different factions within the Democratic Party as well as the Republicans, I think we will see some modest tax law changes by the end of this year. Any major changes we think will be after term elections in 2022, and that'll be dependent on how the economy is doing and how Congress is functioning. So here are some of the things that we think are on during the first term. We think we could see an increase in the top marginal income tax rate from 37 to 39.6%. This one we think is low-hanging fruit, as it'll raise some revenue to pay for all of the stimulus. And as President Biden is proposing it, it's only for people with incomes above 400,000 and would put us back to where we were prior to 2017. It's also possible that they're going to lower the value of income tax deductions for high income taxpayers to 28%. What this really is reinstating the alternative minimum tax. As in the past, however, we think the charitable deductions and mortgage interest will be exempt from that limitation. And it may also allow for Congress to reinstate the state and local tax deduction, because under the old AMT rules, you didn't get the benefit for that anyway. So from a political point of view, they can tell the taxpayer, California, Massachusetts, that they get the deduction, but they really don't. Gotta love the Internal Revenue Code. We also think that it's likely that the capital gains and dividends tax rate is going to go up a little bit, somewhere between 25 and 28%. President Biden has proposed equalizing income and capital gains taxes as a way to lessen inequality, but we think the political reality with a 50 Senate suggests that it's probably going to end up in the 25 to 28% range. And we've been there before in the past with the code, so these are not radical ideas. There's talk about an unrealized capital gains tax. The incoming Senate Finance Chairman Ron Wyden supports the concept of an unrealized capital gains tax. We don't think that's likely to pass, but I'm sure we're going to hear a lot about it in the press because it speaks to the income inequality issues. With respect to the estate, there's three potential changes that we're going to hear about, but we don't think will pass with a 50-50 Senate in the next 2 years. The first one is raising the estate tax rate. Second one is cutting the estate tax exemption in half. And the third is eliminating the step-up in basis. It is possible that we could see a rate increase, and the exemption is already scheduled to sunset back to the pre-2017 levels in 2026. Eliminating the step-up in basis was tried in 1986 and was retroactively repealed due to the difficulty of valuing intangible assets. From a purely selfish point of view, if they did repeal the step-up in basis, it would be a huge boon to the accounting profession. Congress loves to keep us employed. It's great. And also, we might see an increase in the corporate tax rate from 21 to 25%. Most Democrats believe that the 21% rate enacted in 2017 was too low, and Republicans might be open to going to a 25% rate, as this would be a way to help pay for some of the stimulus that's already been enacted. Historically, when there are tax law changes that happen during a year, some of them are applied retroactively to the first of the year. However, with respect to capital gains rates, a change has never been retroactive. I distinctly remember preparing returns in 1997 when the capital gains rate was changed effective May 7th. As you can imagine, our tax clients were not happy with the extra tax preparation fees that they incurred, as we had to manually go through all the 1099s to break out gains pre and post May 7th, as the brokerage firms weren't able to do that. So David and I have given you a lot of information in a fairly short period of time. If you have any questions, you can submit them in the questions sidebar, and we will do our best to answer them. We do have a few questions that were submitted ahead of time, and we will begin to answer them now. So if you are ready, David.
Actually, absolutely, Peri. I'm looking forward to them. Let me just amplify on something that you said relative to the sort of the script for 2021 that I laid out. Ashley, could we go back a slide, please? So here's, again, this is when a party changes hands. So what's the catalyst? I mean, if things are, all right, David, you're so bullish, why are you even showing us something where the market might even duck down? Well, this is exactly the kind of thing that Peri was talking about. Usually when a party comes in, they have all sorts of new policies. And some of the policies are, in my opinion, the net will be a massive positive, when we get through that infrastructure. But as Peri talked about, there will be lots of questions about how this is going to get paid for, if at all. And already some of the skepticism about the stock market revolves around potential tax increases at the corporate and individual level, plus all the sort of the devil in the details that Peri was trying to get at. And so even in 2017, as Wall Street was baking in the promise of tax cuts, there were several 2-3% backoffs as the legislative sausage was being debated and finally getting made. So here is in stark relief. If you try to put it in a political policy context, the stock market's, again, average over 70 years reaction to the legislative sausage getting made. Positive, maybe we don't like that tax increase, we'll sell off. Oh, well, we like this, well, maybe not so bad after all, and so forth. And then finally, when the sausage is made and everything comes together, which is where I think we're going to be, I think there will be a lot of political cooperation from the Republicans in 2021, because there will be the devil to pay by the electorate in 22 if they don't cooperate, in my opinion. So I think this ties very nicely together between what Peri was talking about in this chart. All right. So thank you, Peri, for my indulging me here, and off to the questions.
Okay. Let's see. I guess this is a question that we've gotten from many clients in the last year or so. Are you concerned about the levels of the debt in the United States?
So concern is a relative concept, I believe, not an absolute concept. And so the short answer right now is no. So the debt we're talking about is sort of the accumulation of fiscal deficits that the Treasury has developed, rather than individual debt. There's a difference between the 40 plus of us who are on the call, who have our own finances of balance sheets, and the federal government. The federal government, we can't create money. The federal government can, and it must. And the reason it must is because we have to finance a growing economy every year, and the deficit spending that the federal government runs is a way of creating and inputting capital into the domestic economic system. We'll have, in order to increase our standard of living with a growing population, we must increase the monetary base, the working capital, essentially, for the economy. So I'm not concerned right now. There is certainly economic theory that says that if the government runs too big a budget deficit, and Japan is the sort of the poster child for this at the end of the 80s, when it ran, at least the causation was attributed to this. I think actually Japan has more of a demographic problem rather than a budget problem, but it's kind of hard to extract the two. But there's a theory that says that too much is too much. I will say categorically, at least in U.S. terms, there has never, ever, times 12, been an economic problem created because the U.S. ran a budget deficit. So no, I'm not concerned. Is there an umpty up stage? Maybe. But my sense is that the causative factors that will create the quote problem won't be the deficit itself, but it might be inflation. I think that's another question. So no, I'm not concerned, and I'm certainly not going to be concerned over the next couple of years.
And I'm going to add something to that. Historically, what has happened when the U.S. has run a surplus?
Oh, it's an almost guaranteed recession. When the U.S. runs a surplus, in fact, the last time we did it was 2000, 2001, boom, recession. What happens when the U.S. government runs a surplus is it's extracting money from the economy. It's taking more in than it's taking more in taxes and fees than it's spending. And since government spending is 22% of the economy, consumers like 68, 70, and net manufacturing, if you will, is in the low double digits. When government spending contracts, you're virtually guaranteeing a recession. So no, that would be a terrible idea.
So we get that question a lot also. What are your thoughts on trade deficits?
Trade deficits, I actually put in the same category as budget deficits. We are the world's reserve currency, and that's something I will say we inherited. We took over from Great Britain in the context of World War II. The pound sterling had been the world's reserve currency prior to that. Then, with our, not just sort of our hegemony, if you will, we inherited that mantle, and we've had it for the last 75 years, and I expect we're going to have it for at least the next several decades. We may end up sharing it with the Chinese, but at some point. But I think China's objective is to become the reserve currency in its own part of the world in Southeast Asia. And frankly, I will say parenthetically that it's great we can beat our chests and to be the world's reserve currency, and it's great. However, it's be careful what you wish for, because not only are you responsible for your own growth, you're responsible for everybody else's too. And because it is certainly important that we maintain markets, both import and export markets around the globe for our products, as well as the ability to transact and import wines and cars and cheese and so forth, it is imperative that we run a trade deficit, because that's the way we inject dollars into the global economic system. You want to create a problem around the globe is you tighten access to dollars, and a recession, a global recession, or at least a slowdown will follow, and we will not be unaffected by it. So, running a trade surplus sounds like a great thing. It's not. Trade deficits are just fine.
Do you see inflation rearing its ugly head?
Ashley, can we go back to, please? I'll just go back to that chart. Hopefully she's on. Okay, well, go back to one more, please. So the short answer is eventually yes. One more, Ashley, if we could, please, to the cycle chart. Thank you. So you'll see in 2023, I have that inflationary pressures begin. Inflationary pressures are, again, the inflation that we all sort of remember, at least those of us old enough to remember. I do, even though I was in my teens and early 20s at the time, was the 70s. When we had stagflation, we had inflation with no real economic growth of any consequence to speak for. Generally, when you get inflation, the economy's growing too fast, and there's not enough supply for the demand that's out there. And so, yes, eventually that will happen. But I think, even though I'm sort of making a reference to 2023 as the first sign of inflationary pressures, I don't regard it as a problem, perhaps, until well after that. And the reason I say that is that in order to really get inflation as a problem, you have to embed it in the wage base. The 70s were notable primarily for cost of living adjustments to COLAs that were put into virtually every union contract and even, of course, into Social Security. I think the last vestige of it is still a small piece still in the Social Security system. So in order for inflation to really embed itself, it has to be almost codified into labor agreements. Right now we have, what's the biggest supply we have outstanding on the sidelines? It's labor. What's the biggest cost, the biggest variable cost in virtually every economic, corporate, government, even individual, perhaps balance sheet is yourself. Is your ability to generate income and create wealth through your labor supply. We have a massive amount of labor on the sidelines, and as the millennials, a lot of millennials are still in school. It's millennials right now defined as any fully grown adult 40 and under, but a lot of them are still, the younger ones are still in school, and Gen Z is coming out. There is going to be a massive supply of labor. The labor force participation rate, which is now in the low 60s, it usually should be somewhere in the mid to high 60s. when it finally maxes out, and I don't see that till the end of the decade, frankly, because we have more and more people entering the workforce doing more and more terrific economic things. That's the supply that will, when we finally run out of it and we embed inflation in the wage base, that'll be the time to worry about it. But that's a ways ahead. Occasionally there will be, oil prices will go up, and food prices will go up. And yes, that's, people say, well, we all drive and eat. So obviously that has to be inflationary, and in a transient level it will be. But in order to really get inflation, you have to embed it in the wage base. And I don't see that for a very long time.
Pre-pandemic, we all drove.
Which that's true.
There's been a lot in the press lately about the dollar weakening. You mentioned that a little bit in your comments before. What does that mean for our clients' investments and the economy overall?
So I'll start with the economic side first. I mean, when the dollar weakens, as I said before, currencies trade relative to each other. There's no absolute sense. I mean, we all think of the price of something like a gallon of milk or a gallon of gasoline and so forth. But currencies trade. The largest market in the world. There's commodities the smallest, stocks the next. Bonds, a huge market, but everything's dwarfed by the currency market. I mean, when you reach into your wallet and pull out a $5 bill to pay for something, you're executing something essentially in the currency market. So currency market is broad and deep, and currencies trade relative to each other. So as I said, when the dollar begins to weaken, and especially during an economic rebound, which is almost the only time it ever weakens, is during an economic recovery, then other currencies, other economies look like more favorable places to invest, and so therefore people sell dollars and convert the money to other currencies to go invest, or take trips or whatever they might do. Demand on a relative basis increases more or stronger than within the U.S., even as the U.S. is strengthening itself. So from an economic standpoint, it's terrific. Now, I will say on the home front, it's especially terrific for those who are looking to sell goods and services overseas, because from the point of view of an overseas person, if our dollar weakens, they can more easily buy our products. I mean, so one of the economic policies that was certainly a big part of the last administration was to weaken the dollar. They actually didn't succeed until it started weakening on its own right. Of late, the dollar was pretty strong through most of the last administration, but this definitely provides a greater incentive for other folks to buy our stuff. It does make other folks' stuff for us to buy a little bit more expensive on a relative basis, but the increase in economic activity will more than offset the negative impact of that. So that's economic. From an investment standpoint, it's awesome. Because it allows us to have a currency tailwind when we diversify not just fixed income, not just equity, but fixed income, and we've diversified for our client portfolios on both fronts, bonds and stocks, into overseas investment. It makes, again, if our dollar is weakening, no matter what's happening to the price of the stock on the local market, the local overseas market, it's growing in value on ours. So the currency tailwind is a big deal. Now, even as these foreign economies, I mean, why is the dollar weakening? Is because these foreign economies are doing better and better and better on a relative basis than they were before relative to ours. So you get a double, you get a double virtuous, a double hit, if you will. You get the higher acceleration than expected of the investments that you're making, plus then you get the currency benefit as well. So this is not at some point, could there be too much of a good thing? I suppose, but we're a long way from that.
Okay, and I think we'll finish off on a really positive question.
Ooh, I like those.
Yeah. Are you concerned that the market hit another high yesterday?
Concern? No, I'm embracing it. I mean, what is the bull market? It is. I mean, to sound really glib, it is a succession of highs upon highs upon highs upon highs. I mean, and I will say it's actually healthy for bull markets. As I said, even in 2017, I was a mega bull that year too. Occasionally, there would be a 2 or 3% setback that would sort of reset the tone and allow the market to take a breath. So no, I'm in fact, there are times to avoid risk and there are times to embrace risk. In my opinion, this is a time, and presumably over the decade. The name Roaring Twenties, of course, has sort of a pejorative connotation for those of us who weren't around, as probably nobody on this call was around to live through it. But we all remember what happened. We all know what happened in 1929 and then led into the Great Depression, of course. Although I will further note that 32 to 37 was one of those dots on that prior bull market chart. But in any event, 2029, whether 2029, the 20s resembles the Roaring Twenties of the 20s, resembles the Roaring Twenties of the 1920s, we'll all find out later. But I think the opportunity, the bull markets will be steadily highs upon highs, occasional setbacks of modest, if perhaps not even frettable setbacks. So I'm delighted. You can't have a bull market without successive highs, and I think this is terrific.
And David, I just noticed we have 2 questions that came in from our viewers. So the first one is, and we got to keep it short because we're running out of time. We haven't said anything about climate change and the potential effects of climate problems. I think you could turn that around to where you see the opportunity because of climate issues.
Certainly. So yes, I think we can all sort of create disaster scenarios upon climate change, and I don't pretend to be a climate scientist in any way, shape, or form. However, I think we all know that things get warmer and warmer every year. There's no such thing as pond ice in New England anymore, unless you go up to northern Maine or northern New Hampshire. So climate change is definitely a big deal, and and it's been identified, I think, within every branch of government. Perhaps this latest one was somewhat in denial, as one of the greatest economic threats out there. So I can't deny it as creating ongoing, certainly current and then perhaps future levels of skepticism. However, as I alluded to before and Peri just referenced, the opportunities for climate change mitigation as an industry, it is a problem, yes. Hopefully it will be a solvable problem. If it's not, then all this is somewhat academic, I suppose. But from the ability to create industries to mitigate climate change, I think is an absolute economic boom. Could be. We'll all find out. It's the future. Could be a massive economic boon as more and more resources are generated towards this, and higher, strong jobs, strong industries that could mitigate part of climate change. They might be created out of garages, much as Apple Computer was, that we have no idea what they could be, no idea whatsoever. So it'll actually be the evolution of this, assuming it happens, will be kind of fun, and I'm looking forward to it.
Okay, we have another question. We still have 2 more questions. Is it time to buy bonds?
So it's never not time to own bonds just as a diversifier. They are risk mitigators. I mean, if you're buying bonds for the prospect of lower interest rates over the next, few years, then and for the price appreciation that's involved in bonds, I respectfully suggest that that's not a good idea. Bonds are in and of themselves a hard investment class. Just because the coupon rate is low, there are ways to buy bonds and increase the coupon, corporate bonds, high yield bonds, emerging market bonds. Actually, we've done some diversification there. But I wouldn't get carried away. I think, if you want to embrace risk, you should always use the risk asset class, if you will, of equities. You can take more risk than through the equities. I mean, the commodities market obviously provides all sorts of trading opportunities that can come and go so quickly. We do have a commitment to gold within our world, and just to tie that back to inflation, even though it's inflation that's not the causative factor for gold doing well, it's that they are often result from the same the beneficiaries, if you want to call inflation as a benefit to something that needs beneficiarying, they're often caused by the same thing, which is, too much demand for the currency that you have, and so you look for a currency alternative. And the reason that too much demand creates inflation, but the currency alternative is generally gold. I'll just make a passing reference to Bitcoin. It's not something we're doing. Maybe we'll regret that 10 years from now. I don't know, but Bitcoin is certainly being regarded as a currency alternative. But it's also created its own kind of life of its own commodity, asset class, commodity on triple, quadruple steroids right now. So a reference that it's not necessarily a horrible thing to own, but boy, it's not something we're doing.
And our last question relates to the discussion we're having about the trade war. And the question is, do we see the Biden administration eliminating the tariffs?
Boy, so this is probably way beyond my level of expertise, but I'll make a general comment. Tariffs have been a part of global trade forever. We've had tariffs even with Canada on to protect dairy industries and forest products and things like that. There are tariffs. There have been tariffs forever on European vehicles. So tariffs are a way of governments trying to, in their own way, level a playing field. However, that said, the tariff policies over the past few years were frankly quite onerous. And if I were a manufacturer that even had a more elliptical connection to global trade, I would have been negatively affected, no matter what. So any reduction in the tariff regimen at any level is certainly much more conducive to better trade and friction, and more frictionless, that's an economic term, frictionless economic value. So I certainly, but it's again, this is policy sausage that will take a while to be made, and it will probably be somewhat it'll be so nuanced and kind of ugly, but I think that the trend is certainly going to be going the other direction, and that will be good.
All right, well, we've got 3 minutes left, so Ashley, we're going to hand it back to you.
Awesome. Thank you both. That was excellent. Just a reminder to the audience that David writes a monthly market update, which can be found on the KLR Wealth site, and we'll include a link in our follow-up email that we send out. Also, KLR has updated our year-end tax planning guides for both businesses and individuals to reflect the new stimulus package, which can be found and downloaded under the white paper section of our website. So a link in the follow-up email will be included to those as well. And of course, we'll be sending a link to a copy of the PowerPoint and the recording of today's webinar out this afternoon. And as always, please feel free to reach out to us if you have any questions. We're here to help. So thank you, Peri, and thank you, David. We appreciate it. Thanks to everyone for joining us. We hope you have a wonderful day.
Thank you all.
Thanks.
Bye-bye.